MusclePharm might seem the same to you, but it's radically different from my point of view. So I'll decode that introductory statement a bit later in this content, but on May 15th, 2025, FitLife Brands updated the public markets by releasing their first quarter 2025 earnings report. And I'll be utilizing those financial documents along with notes I took while listening to the earnings conference call and any relevant publicly disclosed information to obviously update you on the recent performance of the various supplement companies within the FitLife Brands portfolio, but also utilize everything as the contextual backdrop for my expanded strategic commentary involving functional CPG, categorical, market dynamics, and trends. But for anyone new to these quarterly content pieces, FitLife Brands sells more than 250 SKUs across 13 supplement brands, each with a slightly different product portfolio and sales channel strategy. In total, the FitLife Brands portfolio is sold through more than 20,000 retail locations globally, but throughout this content, you'll hear me categorize the FitLife Brands portfolio into three segments: Legacy FitLife Brands, Mimi's Rock Corporation, and MusclePharm. And then finally, before we begin, I would like to quickly thank today's sponsor, DOS.com. They're building the first adaptive resource platform. Think digital clone of your real-world operations for full supply chain visibility and manual process automation. Whether you're balancing spreadsheets or have an existing ERP, they work with brands to make sure there's no gaps. With DOS, simplify everything from orders and inventory to procurement and demand planning. Learn more at the link in the description. But let's officially kick off the content with a quick rundown of the FitLife Brands quarterly revenue numbers. In the first quarter of 2025, the consolidated FitLife Brands portfolio had revenue of $15.9 million, which was down 4% year over year, but up around 6% on a quarter-over-quarter sequential basis. And before I transition into sharing a detailed collection of segment-level updates that I think are important when trying to understand the FitLife Brands story, it's important to note that for the first time in probably 2 years, the consolidated portfolio's year-over-year growth rate isn't greatly impacted by M&A related non-comparable aspects. So this is definitely the cleanest financial snapshot that investors have gotten recently. And while the context is wrong, it got me thinking about that Warren Buffett quote, "Only when the tide goes out do you discover who's been swimming naked." But maybe by shifting into that collection of detailed segment level updates, it will help you understand why that popped up into my brain. And let's begin by examining the sales channel mix of FitLife Brands, which has been a major focus of the company's leadership over the last 5 years. But historically speaking, aka the legacy FitLife Brand side, these supplement brands collectively generated most of their revenue from the specialty retailer GNC. And by most, I mean like close to 80% at one point. But that key customer risk felt consistently more problematic because of the seemingly episodic business troubles and strategic leadership changes that GNC has experienced over the last decade. Yet that concentration of revenue lowered drastically year over year in the quarter, as 35% of legacy FitLife Brands segment level revenue was attributed to GNC and only 16% of the consolidated FitLife Brands portfolio revenue overall. And the revenue diversification within the legacy FitLife Brands segment has come from additional focus being placed on e-commerce, and specifically Amazon. Moreover, consider the legacy FitLife Brands mentality of "we don't want to step on GNC franchisees" that avoids channel conflict by pricing products higher on Amazon, and that segment level revenue diversification effort should feel slightly more impressive. Furthermore, after acquiring the Amazon-focused Mimi's Rock Corporation about 2 years ago, FitLife Brands would now actually be considered a digital-first supplement brand portfolio, with e-commerce accounting for about 2/3 of the total first quarter 2025 revenue. But just to kind of close the loop on this sales channel detail for the consolidated FitLife Brands portfolio, quarterly online revenue was approximately $10.6 million, a 2% year-over-year decrease, of which subscription accounts for approximately 30% of the total online revenue. And then quarterly wholesale revenue was around $5.3 million, a 7% year-over-year decrease. Next, how about we shift into some additional segment data detail for Mimi's Rock and MusclePharm, which might also help provide some even further FitLife Brands story context. And in the first quarter of 2025, Mimi's Rock revenue was slightly less than $6.7 million, which decreased 11% year over year. If we look at the Mimi's Rock performance a layer deeper, the Dr. Tobias brand, which represents more than 90% of the total segment, reported a revenue decrease of 11% year over year. But that result was partially offset by a slightly smaller year-over-year revenue decline coming from the two skincare brands. And previously, it was noted FitLife Brands had determined through a cost optimization process that much of the skincare brands business outside of North America was unprofitable, and at times even from a gross margin perspective. Thus, it required eliminating some international business activity and instituting pricing actions within other international markets. But while this cost optimization process seems to be on the tail end of completion, contribution margin increased by 70 basis points year over year within the Mimi's Rock segment, which is impressive when you again consider its poor quarterly revenue performance. And then finally, MusclePharm revenue in the first quarter of 2025 was slightly under $2 million, which decreased 6% year over year. And maybe you're hearing that result thinking to yourself, that's not too terrible, but please give me the opportunity to politely explain just how terrible that internal thought actually is about these MusclePharm quarterly numbers. Firstly, leadership can no longer hide behind the "we needed to unravel the bankruptcy survival focused strategic decisions in years of MusclePharm mismanagement mess" type of excuses. And I'm not naive in the sense that I understand turnaround plans on distressed assets take patience, but FitLife Brands has owned MusclePharm for more than a year now at this point, and I'd be holding leadership to the fire on this poor trajectory if I was a board member. But maybe what's even more alarming, MusclePharm revenue decreased about 30% quarter over quarter. And that sharp sequential revenue loss is obviously alarming in a vacuum, but to really stack on the shocking level of negativity, it's comparing Q4, which is historically a weaker categorical period, to the strongest period within the supplement industry traditionally, mainly because of the new year, new you shopping behavior. And just to continue my assault on this poor MusclePharm quarterly performance, FitLife Brands, obviously hoping to jumpstart revenue growth, substantially increased both top line promotional spend and bottom line advertising investments, but saw seemingly no material positive sales impact. And for those of you that are new to this content, whether employed by FitLife Brands, an industry professional, or supplement industry stan, it might seem like I'm being way too negative here. But since I don't have monetary skin in the game, I've always voiced my frustrations as someone that's been a highly active participant and advocate for the business maturation of the sports and active nutrition category within the broader CPG industry. So when I, someone with deep domain expertise, can see possible resistance and challenges ahead or gaps in the strategic game plan, I'll oftentimes passionately offer up logic-based constructive criticism. Lastly, since I plan on being around for several more decades, I'm honestly rooting on the success of every publicly traded company involved directly or adjacently within the sports and active nutrition category, as I'm a big believer that high tides lift all boats, and that has compounding long-term effects. But then for the final portion of this content, I'm hoping to avoid becoming a broken record that keeps repeating past logic-based constructive criticisms and instead offer up a new perspective that will align with my introductory statement. Though if you're curious about my perspective around key stuff like how FitLife Brands hadn't learned from past MusclePharm experiences, like what became major underlying drivers of its bankruptcy, or how FitLife Brands is chasing a ready-to-drink beverage mirage with zero route-to-market expertise, you could always check out my previous quarterly content pieces. That being said, how about an insight that's a bit fresher. When product-based differentiation proves unable to provide a long-term defensible moat within low barriers to entry CPG categories like sports nutrition, distinctiveness can transform a product from commodity into a perfect experiential foundation for brand storytelling. It's the strategic substance with signature style that sets your CPG brand apart from the landscape of lesser alternatives. So then you might be asking yourself, why do sports nutrition brands accept swimming in the sea of sameness when distinctiveness is a powerful tool to gain a competitive edge that amplifies presence, recognition, and market share? Distinctiveness is rare and difficult to achieve, as it requires both an artistic and scientific approach to create a unifying central idea, requiring the right combination and orchestration of all brand elements. And throughout the initial first half of the Athletes Company existence, MusclePharm had a distinctive brand identity that absolutely defined and then delivered its authentic self. But as it sought to gain more acceptance across the adoption curve and the brand lifecycle matured, MusclePharm failed to recognize that a greater quantity and quality of those distinct brand touchpoints was needed to get continually noticed, recognized, and chosen. And when FitLife Brands acquired MusclePharm in late 2023, it wrongfully assumed MusclePharm still had ample distinctiveness in the marketplace, or at least a sufficient amount to trigger emotional responses with enough consumers to justify its current strategic game plan. That was a miscalculation, one that I believe will require FitLife Brands to thoroughly contemplate its strategic decision to sprint the race without knowing its distance. But how about we end on a more positive note? Firstly, I mentioned earlier that I don't have any monetary skin in the game with FitLife Brands. And honestly, I rarely even regularly look at the stock price, but I do understand that many of my audience utilize this strategic commentary to provide different layers of insights within your investment thesis. So I thought it was pertinent to mention that within the earnings call, leadership noted that FitLife Brands, based on its current market capitalization, should be included within the Russell 2000 index when the next reclassification happens next month. If you aren't familiar, the Russell 2000 index is a widely used performance benchmark for the small cap segment of the US equity market, and inclusion usually drives value due to increased market exposure. And then you might have noticed that within the 10Q filing, despite no deal making within the last year, FitLife Brands incurred some elevated M&A related expenses in the first quarter of 2025. So while that doesn't always mean an acquisition will go to the finish line, FitLife Brands leadership did confirm that expense class increased substantially in pursuit of one or more possible transactions. And I'd pontificate further on possible M&A targets, but I'm a bit confused on what's exactly included within their key investment criteria beyond deal size or multiple and industry focus. So we will see if FitLife Brands tries to get a definitive agreement finalized within the timeline that aligns around the expected Russell 2000 announcement. But I hope you enjoyed the first principles thinking that went into my latest YouTube video. If you did, can you do me a favor by hitting that like button? That quick and free action helps YouTube know my content is worth spreading to more people. Also, we're getting really close to reaching my next subscriber goal, and it would be great if you join me on this journey. But to do that, we need to fix the fact that slightly more than 3/4 of you that are watching this video right now are not subscribed to my YouTube channel, and that hurts my feelings. Regardless, I want to thank you for giving me some of your attention and time, and I'll see you on the next one.